Hey guys, this is Chris, and in this video we're talking about the most divisive stock in the history of mankind. We're talking about GameStop right here, where people either love it to death or hate it so much they want to see it burn to the ground. I'm here to give you a more sensible, fair, in the middle type of opinion here with facts and research and total analysis. We're going to go over some actual business steps that GameStop has done to improve the fundamentals of the business. We're going to talk about the valuation as well, whether or not it makes sense at all, and where do I see it going in the future. And we're going to talk about the business transformation that's going to happen, hopefully, for this company in the near future. All right, so you can see here the GameStop chart, and obviously it's been on comeback since that huge spike up and spike back down. Now, it is almost a $12 billion company here today. It's had $5 billion in sales the past year. Typically, pre-pandemic, they did around $7 billion in sale. You can see the history for this particular company. It did have declining revenues for about the past decade, though, or at least stagnant for many years, right? You could see here from 9 billion to 8 billion to 7 billion. And the latest year was obviously a tough one because of the pandemic, and physical retail stores did not have great same-store sales. To their credit, over the past couple of years, actually, not even just talking about the recent moves with Ryan Cohen on the board, the guy who was from Chewy, who created a really great e-commerce business. They've actually been trying to reduce the overall debt of GameStop company. They've been trying to reduce the number of stores that they have operating and at bad sales and bad income. So you can see here that they have been, and this is from 2019, focused on building a digital-first omni-channel model that delivers a best-in-class e-commerce experience, including the most comprehensive set of games and entertainment products and events. And they're really trying to increase the availability and the supply and different types of games on their websites to be a differentiator when it comes to e-commerce sales of games, as opposed to the likes of Amazon or even Steam, which we'll talk about a bit when it comes to valuation. Now, you can see here that GameStop reported fourth quarter earnings and fiscal 2020 results. And the great thing was that it did increase sales during the fourth quarter, with global e-commerce sales increasing 175% in the fourth quarter and 191% in fiscal year 2020. And that is actually about 30% of their net sales now, 34%. The way forward is going to be driving digital sales and revamping their physical stores and transforming it into something that will be higher margin business, perhaps a service business, some kind of entertainment related business where people go to stores and they play games there, or they do something with esports, that type of thing, and they close down more stores that are not performing, that are just a drag, when it comes to paying expenses for those stores, taxes and whatnot, when they could just sell them off and just use the funds to do, other profitable adventures. Overall, the past year, they did about a 215 million net loss on a 25% margin. So the margin actually went down, largely because of the shift to e-commerce. Over time, the cost of selling online should be lower than at physical locations, but building out that infrastructure with their fulfillment process online is definitely a expense right now that they're working on, and they did run more promotions in 2020. And you can see here there are some preliminary sales results for the first 9 weeks of 2021. But generally speaking, it's going to be what is going to happen in the future for this company. What I like about the case for GameStop stock is that they are taking those steps towards that digital future. So they have been making changes in the executive team, in the board of directors and whatnot. So they are going to search for a new CEO. What they also have done is what I really wanted all of these Wall Street bet stocks and the likes of AMC as well to raise cash. So they had succeeded in completing an offering to raise about $551 million. Now, another thing I like about GME stock here is that they did reduce inventory drastically. So that is something that they just take off the balance sheet. They sell, and they have more cash flow that they can use for their business. And another thing is they decreased the amount of debt that they have by 57 million. All right, so overall, this company actually does not have that much debt. It's not actually as bad as you would think, especially when compared to some other stocks with billions of dollars in debt. So as of January 30, 2021, the company had $146.7 million of short-term debt and $216 million of long-term debt. So after the offering, technically, they could pay off all this debt if they want to, but obviously a better use of that cash right now is to fund its transformation. So as I mentioned earlier, this is a $12 billion company at this point in time with the share price of $169 here as of recording. They don't have a PE ratio because they have been taking a loss. They have been taking a loss for a couple of years now due to some unprofitable stuff once again. They had a lot of business mishaps, including at one point they wanted to buy hundreds, if not thousands, of different AT&T stores and use that as a different source of revenue. They did like Apple repair product type of thing. I don't know what they were thinking at that time, trying to branch into things they had no business doing. But when a company has no PE ratio, you need to look at the price to sales ratio and kind of think about where this is going in the future and how similar companies of that category are valued. So a price to sales of 2, if it is a true e-commerce company, at least it gets to a 50% e-commerce, if not a majority e-commerce type of business, it may actually make sense. It makes a lot of sense actually, at a price to sales of 2, and if sales can be about 5 billion and possibly work its way back up to a 7 billion or towards 10 billion someday with higher e-commerce margins. Right now, as I mentioned, gross margin is 25%. Profit margin was negative. But if they can get to, let's say, 5, 10, 15% profit margins, then this company all of a sudden is definitely going to be quite profitable, making a few $100 million in profit, when a lot of e-commerce companies may actually not be making a profit yet either. So a price to sales of 2 would make a lot of sense. Even a company like Amazon has a price to sales of 4. That Amazon gross margin 40%, profit margin 5.5. So it's not like Amazon, for every $100 it sells, it's banking $50. No, they're just banking $5 off of that actually. But it's still a fantastic business because of the sheer volume of sales that it gets and how important it is to society, or at least the particular sector and industry that it's in. You look at a couple other companies like an Etsy, for example, which is e-commerce based, and that is a price to sales of 14.8. Again, these two companies do have earnings though, unlike GameStop. So GameStop has a lot to prove. It has not even happened yet, really, this digital transformation. And their e-commerce side is not yet at high margins and not yet delivering over 50% of their sales, if not more than that. So they need to have consistent growth, like Amazon, like Etsy, like other e-commerce companies that have benefited from the pandemic and even before the pandemic, where they're growing double-digit year after year after year. GameStop is difficult. It's not easy. And honestly, there are, in my personal opinion, a lot of other easier ways to make money. But hey, if you want to be part of this movement, if you really believe in GameStop, if you really think it's going to transform and do double-digit growth and have all this business, then yeah, it's totally possible that a price of sales of 2 is actually low. If it gets to a price of sales of 4, of 6, of 8, of 10, of more than that, then you're talking about multiples of the current stock price because the valuation is doubling or tripling or quadrupling. But there is, again, I can't stress this enough, right? A lot to prove. Now, lastly, on a valuation note, I do think it's very interesting. There is a company called Valve Corporation. They have a subsidiary, which is Steam, video game publisher and developer as well, distribution. So they kind of have what I believe is what GameStop should be really pivoting towards, at least partly. This is a company that is valued $10 billion as of March 2019, and probably at this point in time, I wouldn't be surprised if it's 15 or 20 or more than that. Ultimately, though, I want to make the quick point that valuation at the end of the day sometimes does not matter, does not make sense. It's no point rationalizing it. You look at the likes of Dogecoin, where it went from 1/5 of a penny all the way to 27 cents in just a couple of years, and you could argue that there is nothing really fundamental about it. Maybe some people argue otherwise, but you know, at the end of the day, it's very similar to GameStop. A lot of people would never have expected it to stay above even 50, let alone 100 and close to 200. All right, guys, that's it for this video. Hope you enjoyed. Make sure to please like the video so the algorithm in turn likes me just as much as I like you guys. And until next time, my friends, stay well and invest responsibly.